An interest rate is essentially the cost of borrowing money or the return you earn for saving it. When you take out a loan, you pay interest. When you deposit money into a savings account, you earn interest. It's typically expressed as a percentage. For example, if you borrow $1,000 at a 5% interest rate, you'll pay $50 in interest after 1 year. But beyond personal loans and savings, interest rates are a vital tool used by central banks to manage the broader economy. When interest rates rise, borrowing becomes more expensive. This tends to reduce consumer spending and business investment, which can help slow inflation. On the other hand, when rates fall, borrowing becomes cheaper, encouraging spending and investment, but also raising the risk of inflation. Central banks, such as the U.S. Federal Reserve, adjust interest rates to maintain a balance, seeking low inflation, steady growth, and stable employment. Globally, interest rates influence currency values, trade flows, financial markets, and real estate prices. For individuals, interest rates affect many aspects of daily life. Higher rates lead to more expensive mortgages and loan payments, while lower rates can make buying a home or financing a car more affordable. Credit card interest rates also fluctuate with the broader rate environment. On the savings side, higher rates provide better returns on deposits. Additionally, changes in interest rates can affect job opportunities, as businesses respond to changing borrowing costs by adjusting hiring and investment decisions. In the United States, interest rates have followed an eventful path over the past several decades. In the late 1970s and early 1980s, the Federal Reserve raised rates dramatically, peaking above 19%, to combat extremely high inflation. During the 2000s and especially after the 2008 financial crisis, rates were brought down significantly to stimulate economic recovery. In 2020, as the COVID-19 pandemic hit, rates were again slashed to near zero to support the economy. Then, beginning in 2022, the Fed raised rates sharply to fight the highest inflation seen in over 40 years. These shifts highlight how interest rates are used to respond to major economic events. As of mid-2025, the Federal Reserve's benchmark interest rate remains between 4.25% and 4.5%. After several rate cuts in late 2024, the Fed has currently paused further adjustments to assess the economic outlook. However, Trump is eager for the Fed to significantly lower rates, from the current 4.25% to 4.50% down to around 1%, in order to reduce government financing costs and support economic growth. Lowering interest rates could further stimulate economic growth and employment. It would make it cheaper for businesses to borrow, encouraging investment, expansion, and consumer spending. For everyday people, a rate cut means lower mortgage rates, easier home buying, lower credit card interest, more active consumer spending. It could also push the stock market higher, as low rates make stocks more attractive and capital flows more easily into the market. Fed Chair Jerome Powell is still committed to the Fed's dual mandate, controlling inflation with a target of around 2% and promoting employment. Although the European Central Bank has already made several rate cuts, Powell believes the U.S. economy is different from Europe's and shouldn't follow suit blindly. Since U.S. inflation has not yet shown a steady downward trend, cutting rates too soon could spark market anxiety and an inflation rebound. The Fed has stated that its interest rate policy is based on data, not political pressure. So what do you think? Should the U.S. cut interest rates or not?